Welcome to Deep Dive. And today we'll be talking about mobile lending, mobile loans, mobile credit. And to help us to have this discussion is Zeituna Mustafa from MicroSave, which is a financial inclusion consulting firm. We also have Rose Muturi, who's the country lead for Tala, one of the mobile lenders in Kenya. And of course, we have Edoardo Totolo from FST Kenya, who has done research in mobile credit and financial depending. Karibuni sana. Welcome to Capital FM.
Thank you.
Thank you.
Yeah. So to start with, CBK Governor Dr. Patrick Njoroge last week was quoted saying that digital platforms need to be regulated and they need to be brought into the fold of the National Payment Systems Act. He was quoted to say that the digital mobile loans are worse than Shylocks. That's his exact words. And the reason he said that is that Shylocks at least hide themselves, and but mobile lenders are on your face, send you texts to borrow money. They are all over on your face and advertising. But from the conversation that we have been having as a nation, we have been wondering if it's time to talk about regulation in the mobile lending subsector. But there's no denying the fact that the impact of mobile loans has in the Kenyan economy. We started 6 years ago with M-Shwari. We have now over 25 mobile lenders. According to CBK, there are 6.5 million digital borrowers in Kenya. And like most countries, technology, innovation precedes regulation. So this is where we are, ladies and gentlemen. To start with, what do you think about those comments, Rose, from the CBK governor? He says that you are worse than Shylocks. What's your take on that?
Well, I may not want to answer specifically my reaction towards that comment, but what I can say is, as a digital provider, being Tala, where our main aim is to provide access, choice, and control to the underserved globally, we are looking forward to working with regulators to ensure that our customers' financial needs are met as well as their rights are protected. So in that regard, and historically, because we've been working with the underserved population, then these people may actually be unfamiliar with what the regulation says. They may be unfamiliar with everything to do with the Consumer Protection Act. We would be willing to work with the regulators to ensure that the consumer is protected.
Zeituna, considering the rising number of loan defaulters and more lenders being listed negatively by credit reference bureaus, how do we regulate this industry? What are the options that we need to look at?
Thank you. First of all, let me start by saying regulators and policymakers face new challenges in protecting consumers, and there's need to update regulations to address fast evolving digital lending channels and business models, even adding to that new players. So having been in the industry and working with partners, we feel that there should be some level of regulation to protect and safeguard the customer, and at the end of the day, streamline the market. So some of the recommendations we might give is actually having audits of the CRB digital credit database for accuracy and completeness. The Financial Market Conduct Bill, if it turns into an act, will go a long way into protecting the customer and the provider altogether. So
what are some of the things in this bill, just to mention a few, that will be directly impact mobile lenders?
Thank you. So like the data privacy and transparency, that to me is integral, because with transparency and also data privacy, which is a big debate even globally, I feel that providers and also regulators can work together and ensure that client is protected. Secondly, I think on marketing, where the regulator actually says opt-in and opt-out options, and even having terms and conditions pre-approval, this will go a long way in regards to even having ripple effect onto the repayment. Why am I saying this? It's because our research has actually shown that if the customer makes the decision and choice before taking the loan, there is a likelihood, and from design thinking, we've actually seen that customers have likelihood to repay.
Okay.
Yes.
Rose, before I get to Edoardo, I'm sure you're familiar with this bill.
Sure.
Is this something that you, as an industry, are ready to adopt? Do you have any reservations in some of those clauses?
Well, actually, we even had given our comments when the bill first came out, because they had allowed for public participation. So we are aware of all the facets that they've raised, and I'm happy that it is a financial markets conduct bill, meaning it's gonna actually be looking after every institution that offers financial services.
Okay.
So going back to what has been mentioned, things like, for instance, the customer being able to opt in, we already practice that as Tala. For instance, making sure that the customer understands what they're signing up for, we do that already. What kind of information do we provide the customer with? Because we are redefining how we are providing credit to our consumers, we actually use very, very simple language. We've tried to demystify what financial services are so that it doesn't look so far-fetched to the target market we're after. So all these things we've looked at, and like I said, we are willing to work with the regulators so long as we are called in to say this is how it can be implemented within the microcredit industry. We would be happy to work with them and see how it can progress.
So you are more than happy to be regulated?
Actually, I think it's a good thing with regards to, you mentioned more than 25 microcredit or digital lenders out there. There are more than that. Some may be very small entities that are coming in. It sometimes looks like it's the most lucrative industry to get in right now,
Yes.
but it could be affecting the consumer. So making sure that every participant in that industry is fully registered, they have all the proper documentation, source of funds are verified. Some of those things actually I think would be good for the industry.
Okay.
Yeah.
Edoardo, you have done, of course, you and FSD have done research around this space, mobile lending. What can you tell us? What has been happening over the last 5 years? It had very good intentions of financial deepening and financial inclusion, but where are we now?
Thank you. So we've done some research to understand a variety of things. As you said, since inception, since basically the launch of Mshwari at the end of 2012, we've seen more and more providers coming into the market. We see digital credit, or mobile credit as you call it, becoming incredibly relevant and widespread, and we see it all over the place in social media. We see it, people discussing about it even on the street. So something we wanted to do is to exactly get a more a proper way to measure the market, see how many people are actually borrowing mobile credit, how are people using mobile credit, for what reasons, and what are the opportunities there, what are the risks that are emerging. So what we found is that indeed, like our initial impression that the market is growing is actually true. What we found is that about 1 in 3 mobile owners in Kenya has tried mobile lending at least one time in their life. So 1 out of 3 means that it's over 6 to 7 million unique borrowers in Kenya. That has become by far the largest source of formal credit in Kenya. So digital credit basically in a few years has been able to do what conventional banking or even the cooperative system has been able to do over a long period of time. So 1 in 3 Kenyans phone owners are borrowing. People who sign up and borrow once, they tend to do it again. It's not something that people just try and drop. What we notice is that actually people tend to borrow repeatedly. Some do it maybe on a monthly basis or just occasionally, but many are doing it very often on a daily, weekly basis. So clearly the costs in that case grow, and they are relevant.
Okay.
So this is an emerging market, is changing by the day. It's not something that is stagnant in any possible way. So what is important to do now is to keep an eye both on the opportunity that this new market segment brings to Kenya, to Kenyan households and businesses. At the same time, we need to check what are the risks that are coming up, because there are more and more providers, and there are more and more people borrowing.
Okay. Your research also points out to a number of people who are defaulting. What are some of the reasons people are defaulting, and paint us a picture of what is happening in terms of interest rates and defaulting?
So it's an incredibly diverse world, digital borrowing. I think like just painting a unique narrative of it would be a mistake.
Okay.
So there are very different stories, very, very different dynamics that occur. And what we can do, like in our research, what we try to do is just to understand what are the main ones. Though, like I think it would be difficult to paint a complete picture of what is happening. What happens is that primarily people borrow either because they have some day-to-day needs that they need, they have they're short on their, cash flow, and they need some, credit to basically maintain consumption at the same level. So people.
So this is to buy food and for day-to-day.
Day-to-day expenses, yeah. And buy food, it can be even paying bills. In some cases, it can be paying for a cab ride to, somewhere you really need to go to. It can be like simple things as that, and that is actually the key use case. So the way people default, just to go back to your question, happens primarily because there's a problem with the either the source of income. So people borrow expecting a source of income to come the next day or the next week, and that doesn't happen. So that's when people are short of cash, they're unable to repay. The other one is maybe someone borrows for business purposes, and then maybe the business doesn't get the revenues that the person was expecting, and there we have problems with default. There's also some people that in the research admitted just having basically being a poor planner. They are planning, or they were thinking that they would be able to pay back, but then as they had the money in their pockets, then they realized actually that their math didn't match.
Okay, so there's need for clearly financial education. Just like in any financial institution, financial sector, there's some level of financial education that is needed, not just for micro borrowers, but across the board. Is that something that can be fairly stated?
I would agree with that, yes. But I would say that at the same time, the disclosure of pricing, of terms and conditions needs to be improved as well.
Okay. Let me add on to that, because we've done qualitative research now, going deeper into the perception, the motivations and the triggers of why customers default after finding out that 2.7 million Kenyans have been listed in the Credit Reference Bureau.
2.7 million?
Yeah.
Okay.
And that number is a year ago, a year and a half ago.
Is this just for digital lenders or across board?
Digital lenders. Okay. And 400,000 of those are amounts below $2. So with such scary numbers, we commissioned a qualitative research to deep dive into the nitty-gritties, why they do this, the behavior around it, and we actually got we used behavioral economics, as Edoardo has just said, to actually bring out the prompts that come from the insights that we got from the market. And this report actually dissects the segments into three personas that were salient or repetitive: the juggler, the defaulter, and a repair. And we had recommendations for each, how to actually treat these customers, how the provider should actually relate with these customers. And at the end of the day, the design thinking and behavioral economics and the human-centered design, which we have a tool in-house at MicroSave, actually some of the recommendations is the opt-in, opt-out, and even pre-terms and conditions before approval, so that customers can make consent, informed consent, and so forth. And it's actually something that we think the market needs more of market-driven research to explore even this defaulter more deeply and bring out the nuances that they face. Because inside the defaulter, there are even types. As Edoardo had said, one has poor planning, another one is just a professional defaulter who just...
It's a professional defaulter.
Professional defaulter.
They borrow from one mobile lender, and then they move from different mobile lenders.
Yes, even some youth that were in our research, you could actually hear of total negligence, whereby they say, if they can't see me, they can't find me. They think the computer is speaking to them. So interesting nuances that you pick from these customers, and if we understand them fully, we can actually tweak these products and the pricing.
Zeituna, we want to listen to some of the people we talked to. Went to Nairobi downtown. Some of them were business owners. Some of them were hawkers. We just want to hear them and just understand what their issues are.
Hata kama sio biashara, maybe umepata kitu ya emergency, inaweza kukuokolea bado. Ukichukua 2000 so unaongeza 128 juu.
Interest iko juu. Jana nilikuwa nimechukua 3k, although nimekuwa nikichukua kidogo kidogo. Ya mwisho ndio nilichukua 3k. Na ndio sasa unaona interest ikianzia kuanzia 1000 na unaona hiyo inapanda juu kiasi. Na hiyo ndio tunaona iko juu.
So ulichukua 3000 ukalipa interest ya?
Yeah. 761 hapo.
Unaweza jinua sana. Utachukua na 2k. Utachukua pia unaweza pata, let's say by after 1 month. You know, duration unajua ni 1 month. You can just pay weekly. Unapata almost kisha mwezi unapata already ushaanza.
Sasa walinipea 1 week niko nimelipa. Sasa hiyo 1 week siko na sawa, kanaongeza sijui for 20 ni do mob. Ndio pia interest iko high. Mbona wako hivyo? Nilichukua 5000 interest yao sasa ni 750. Una imagine 750 ndio iko juu. Sasa loan yote nimeona inakuja kwa 6k 210. Na nalipa vile nataka.
So, Rose, I don't know what you hear from what we have just had, and of course the feedback that you get from your customers. Do you feel like these interest rates are too high?
Actually, good question. And listening to what you've just played in that clip, it means the market is evolving.
Okay.
Because by the time we started, Tala is 4 years old in Kenya, and we did extensive research to find out what would we use to target the customers that we're after, the underserved, like we mentioned. And from several responses that we did, we actually did interviews to more than 3,000 customers across the country, and the issue of pricing was not in the top 3. The first one, which was most important, was access.
Mm-hmm.
The second one, of course, still looking at how will the product work, how soon do I have to repay, and such things. So right now, when you come to pricing, it means the market is evolving. And this is usually a factor of if there are many players in the market, you have options.
Mm-hmm.
So you can start looking at more details. Now, for us as Tala, one of the founding principles that we have is radical trust, both internally and externally. Meaning we do have radical trust with our customers. Of course, we use our credit models to bring in customers through the funnel, and we're able to give them the loan. So by the time we're believing in taking that first risk in the customer, it means we have been able to assess both the ability and the willingness to pay through the data that we're able to pick, and we give them the facility. So from the data that we have, it's proved that the consumers are repaying and they're happy, because I was mentioning earlier before the recording started that the advantages outweigh the disadvantages. That's why we have close to 2 million customers who are borrowing from us repetitively and are constantly paying, because they know the more they pay, they get benefits, the higher limits, they can actually access higher limits, they can actually even get better terms in the future. So the education is working based on what we've been able to provide to them.
Okay. So the fact that you're having repeat customers, is it a testament of that they are happy with the product?
100%. Actually, more than 95% come back every month. So that surely means we're doing something right. Okay.
Zeituna, it's clear that there's, of course, there's no debate about this, that there's a demand, there's a need for this service. And of course, there's a cost to this service, the financial service. But what will be wrong if this digital lender say, this is our pricing for this kind of service? Is there a model that maybe we are not seeing?
Thank you. So providers, I understand where they're coming from, and there are some key drivers, 3 that I can saliently say that drive high interest rates. One is the small size of loans. These loans are small. The cost of the same amount of loan is still the same. So because of that, providers also have to put the markup that to sustainably serve in the market. And data analytics, not every mass market has digital footprints. And with the fuzziness of this, digital lenders also have to safeguard themselves if the digitization of data is not up to par. And maybe here we can recommend even governments and regulators coming in and circulating money digitally through G2P payments, P2G payments, and even other e-commerce payments. Then so we can help the providers to actually see the profiles that they are lending to and also segment them. And then risk premiums. This is where I feel that even digital lenders need to segment the profiles, because not all customers are bad repayers. Some are actually good repayers. How do we give incentives to the good repayers? So risk premiums, bundling them together, I feel might not come out best in future. So bundling, instead of bundling them, making sure that they are segmented with the personas that have come out of the market research, and even exploring it more. So these are the three things that are key drivers of interest rates. However, they are still high. I actually was talking to some youth because I'm writing a blog on sport betting and digital products, savings, investing, and even credit. And some of the youth were telling me, I don't have choice. Because I asked him, so why are you taking the loan? Because he has betted all his money, now he has to look for some loan, so to pay his boss or even pay rent. Then he's like, why are you taking this particular product? Because he had told me the interest rate, which was very high, and he's like, I don't have choice. So I feel providers need to still give the choice, let the customers prefer, choose and use. However, give them choice and options.
Edoardo, there's something Zeituna has mentioned about the relationship between betting and financial mobile loans. What's the link? I don't know if it's your survey or another survey that we saw. Is it 6% or 3% of digital borrowers or digital borrowers actually take loans to bet? What's the relationship? Have you seen any relationship in your research?
Yes. So it's something that we wanted to understand. That's one of the concerns related to the growth of mobile lending is, as you said, the relation to mobile gambling, mobile betting, especially sports betting. So we asked respondents whether they borrowed money through their mobile to then bet on their mobile. And the answer that we got was actually surprisingly low. I think only 3% of the borrowers said, yeah, I borrowed to gamble. However, I think, the situation might be a bit more complex. In fact, I mean, something that we noticed in the same research is that people who borrow through their phones, are twice as likely to try mobile gambling compared to people who don't borrow from their phones. Whether now it's indirect relationship. You know, one of the things that we say in economics is, correlation is not causation. Doesn't mean that you necessarily borrow to pay for the gamble. But what we know is that mobile credit appeals to the same segments, demographics, as mobile betting.
What's the demographics, just to give us some context?
Yeah, the large majority of both mobile borrowers and mobile gamblers, they tend to be young. 18 to 25 is the penetration is the majority. Actually, the majority, I would say, is in the age after that, which is 26 to 35. That's the core user segment. 18 to 25 is high, but the highest penetration that we have observed is in the segment 26 to 35. People tend to be urban in cities, Nairobi and surroundings, Mombasa surroundings. And actually, mobile borrowers tend to be relatively highly educated. They tend to be tech savvy. They know about the smartphones. They have, they use internet all the time. They have secondary degree or even more at times. So that is the type of segment that represent the core of the market at the moment.
Okay.
And is the same one that, according to our research, appeals also to the mobile betting industry.
Okay. What would, I don't know if it's your personal opinion or from the research, in terms of interest rates. I don't know if the people you surveyed, did they have any issues with interest rates? Did they think they're too high or affordable or okay?
I mean, the problem number one, really, according to our respondents, was the term of the loan. They say that 30-day loan, which is the majority, is too short.
Okay.
Especially when they're not able to pay. Many people, they try to repay even the day after. But the moment they miss that chance, because as I said earlier, maybe there's some problem with their income or the business, then the 30-day limit is too short. Okay. And so many people feel that is the first thing that they would like to change in digital credit. As Rose said earlier, and I agree with her, access is, at least in the beginning, was like more of a problem than cost. However, I have to say that the market is maturing. Okay. Now, many of the borrowers are not necessarily first-time borrowers. They are repeat borrowers who have come back over and over and over again. Some even borrowing maybe 5 or even 10 times in a month.
As we wind up, just maybe get the parting shots from each one of you. Zeituna, what will be the best case scenario, especially for the borrower? What would you want to see down the line, 1 year, 2 years down the line?
Thank you. I think one is market-driven research. A lot of data, because the digital credit, still we don't have much information. Yes, FSDK, MicroSave, and CGAP have been doing a lot of research on this space. We deepen this and even do large-scale market-driven customer-centric research to actually get the concepts that drive this product. Empowering customer, which Rose has been saying about awareness and educating them, so that they actually even understand the nitty-gritties of what they are getting themselves into and how to actually make this market be more sustainable, because I believe credit is the path to financial access. Okay. And I feel that this product needs to be tweaked a little bit, pricing in the market, the structure, and the product design and the marketing around it. And we are good to go, and we'll have a product that will deepen financial inclusion and also sustainably have our very disruptive providers in the market. Okay.
Rose, looking down the line, what will be the future of mobile lending? We want to hear the central governor say this is the best thing that has happened to Kenya. Not that we don't want to hear that they're comparing you with Shylocks. What steps do you need to take as a subsector to make that leap forward?
So one of the things, and just going back to a few of the points that were mentioned in the Financial Markets Conduct Bill, would be, again, we are embracing regulation. We're saying if the service providers could be registered in a particular framework, that will be good, so that every user knows when I'm downloading this application, it is regulated by a particular body. We are okay with that. Number two, again, if we can be looked at as partners, because the target segment we're after, a lot of the conventional lenders would not touch. It's deemed to be very, very risky. So if we're able to work together where we channel these customers through the funnel, because we're able to really assess that risk and we're able to lend and provide that digital credit behavior, we can easily migrate those customers after a few months to the conventional banking sector. So I see us working together, not being looked at as, hey, you are selling very quickly, very fast, because when it comes to digital, it's a very exciting world and there's lots of opportunity. I also see a situation where, because we are constantly striving to better understand our customers and their behaviors as well as their financial needs, we'll get to a point where we will be able to anticipate even the sophisticated, difficult life events and have customized products for that at the very micro level as well.
Okay. Edoardo, you get the last word. There are
honored.
gaps, of course. There are gaps in the industry, but what do we need to do to fill these gaps?
I say number one, regulation. We need to have a level playing field where all the providers, whether they're banks or non-banks, they have clear regulation they have to adhere to for consumer protection, as well as disclosure and transparency and a number of other things. So regulation, I'll put it on top at the moment. Second, I think I hope that in the future, in the next few years, there will be more competitive dynamics in the market, so that there will be getting a good borrowers would be difficult for providers. They will have to provide a more a better loan, which is less expensive, which is on a longer term. So better terms for the good borrowers. And three, I would say in the future we should have a situation where the transparency and the disclosure terms are equal across the board, so that all the customers, all the borrowers know ahead what kind of loan, what kind of contract they're signing up. Instead, now often it happens that borrowers are not aware of that.
Okay, thank you very much. We have been talking to Zeituna, Mustafa from MicroSave. It's a financial inclusion consulting firm, and we have also been talking to Rose Muturi, who's the country lead for Tala, and it's one of the mobile lenders in Kenya. And of course, we talked to Edoardo Totolo from FSD Kenya. They've done a lot of research on credit, mobile credit and financial deepening. We've been talking about mobile loans and which way forward, how we can improve the subsector, where are the gaps, what needs to be done. And it's clear from the discussion that the panelists have agreed that yes, we need regulation. They are on board in terms of just the way forward and what is the best thing ultimately for the borrowers. Thank you very much for joining us. My name is Ken Macharia for Capital FM Business.